There is a question I asked every single student who walked into my classroom at Columbia University before I taught them a single thing about stocks, or bonds, or balance sheets. I asked them one question, and their answer determined everything about how I taught them and everything about how they should invest for the rest of their lives. The question was not, what is your risk tolerance? The question was not, how much money do you have to invest? The question was not even, what is your financial goal? The question was this: how much of your life are you genuinely willing to give to investing? Not how much money, how much life, how much time, how much mental energy, how much of your reading hours, your thinking hours, your research hours. Are you honestly prepared to dedicate to the serious study of businesses and financial statements and market cycles? Most of my students shifted uncomfortably in their seats when I asked that question because they had never thought about it that way. They came to Columbia to learn how to get rich. They had not come to confront an honest question about how they actually wanted to spend their time on this earth. But that question is the most important question in all of personal investing, and your answer to it determines which of two completely different paths you should walk today. I am going to explain those two paths. I am going to explain them completely and honestly, so that by the end of this video, you will know exactly which investor you are, and exactly what that means for every financial decision you will make from this point forward. The mistake that costs ordinary investors billions every year. Before I explain the two paths, I need to destroy a myth that the financial industry has spent decades carefully constructing. The myth is this: there is one correct way to invest, and the more actively you participate in it, the better your results will be. This myth benefits brokers, it benefits financial media, it benefits the entire apparatus of Wall Street that profits from your activity and your anxiety. It does not benefit you. The truth I discovered over decades of studying markets and watching ordinary investors succeed and fail is almost the exact opposite of this myth. The vast majority of individual investors would produce dramatically better results if they did dramatically less. But here is the cruel irony. The investors who would benefit most from doing less are almost always the ones doing the most. They are checking their portfolios 3 times a day. They are reading every earnings report. They are reacting to every piece of financial news. And they are convinced that all of this activity is making them more informed and therefore more successful. It is making them poorer. And the investors who could genuinely benefit from doing more, from going deeper, from developing real expertise in specific businesses and industries, are often sitting on the sidelines, convinced that serious investing is beyond them. Both groups are walking the wrong path. I spent years thinking about this problem, and the answer I arrived at was that investing is not one discipline. It is 2 completely different disciplines that share the same vocabulary, but require entirely different temperaments, entirely different time commitments, and produce results by entirely different mechanisms. I called them the defensive investor and the enterprising investor, and understanding which one you genuinely are is the most important piece of financial self-knowledge you will ever develop. Who is the defensive investor? Let me describe the defensive investor not as a lesser version of the serious investor, but as someone who has made a specific and entirely rational choice about how they want to engage with markets. The defensive investor has decided, and this is a real decision, not a default, that their time, their energy, and their mental bandwidth are more valuably deployed somewhere other than the deep study of individual businesses. This person might be a surgeon who is genuinely brilliant and earns an excellent income, but whose expertise and passion is medicine, not finance. This person might be an entrepreneur who is building a company and whose best return on their hours comes from focusing on that business, not on researching stocks. This person might be a teacher or an engineer or a parent of young children who simply does not have the hours to do the research that serious individual stock selection requires. Or this person might simply be someone who has examined their own temperament honestly and concluded that the emotional volatility of active investing is incompatible with their psychological well-being, and that no potential extra return is worth the chronic anxiety that comes with it. Every one of these people is making a completely rational and defensible decision. The defensive investor is not passive by accident. They are passive by design, and that design should be deliberate and systematic for the defensive investor. My prescription has always been simple, and it has aged remarkably well. Even as the specific instruments have evolved, own a broadly diversified collection of high-quality businesses. Do not try to beat the market. Accept the market return. Add money consistently over long periods of time, regardless of what the market is doing, and do not touch it. In the modern context, this translates almost perfectly to low-cost index funds purchased regularly through good times and bad, with no attempt to time entries and exits, and with the discipline to ignore essentially all financial news. This sounds boring. It is boring, and boring is precisely the point. Here is the mathematical reality of boring. If the defensive investor simply matches the broad market return over 30 years, the power of compound interest turns even a modest, regular investment into a life-changing sum of money, without a single hour spent reading an annual report, without a single sleepless night worrying about an earnings miss, without a single emotional decision made in a moment of market panic. The defensive investor trades the possibility of extraordinary returns for the near certainty of very good returns, and the complete elimination of the risk of catastrophic self-inflicted losses. For most people, in most circumstances, that is not a compromise that is the optimal trade. Who is the enterprising investor? The enterprising investor has made the opposite choice. They have looked at the question of how much life they are willing to give to investing, and answered honestly, yes, I am willing to give it a great deal. And they have meant it. The enterprising investor is not someone who checks their phone more often. They are not someone who trades more frequently. They are not someone who follows more stock accounts or reads more financial headlines. The enterprising investor is someone who is genuinely willing to do work of a quality and quantity that the average investor will not do. I want to be very specific about what that work looks like, because there is a massive gap between what most people think serious investing requires and what it actually requires. It does not require complex mathematical models. It does not require a background in finance. It does not require sophisticated software or expensive data services. What it requires is this: the willingness to read financial statements carefully and completely, not just the headlines, but the footnotes, the willingness to understand specific businesses deeply, to understand how they make money, what their competitive advantages are, what their vulnerabilities are, and what could cause them to permanently decline, the willingness to wait, sometimes for years, for the right price, on the right business, and to resist the constant temptation to act simply because action feels productive, the willingness to hold a position that looks wrong and feels uncomfortable, while the broader market disagrees with you, because your analysis tells you clearly that the underlying value is there, and above all else, the willingness to be honest with yourself about when you are genuinely thinking independently and when you are rationalizing what the crowd is already doing. The enterprising investor does not try to do everything. They try to develop genuine expertise within a specific domain. They stay within what my student, Warren Buffett, later called the circle of competence, and they go very deep within that circle rather than ranging widely outside it. If you understand the restaurant industry better than most people, because you have spent 20 years in it, then that is your circle. Study restaurants, understand restaurants, wait for mispriced restaurant businesses, and act decisively when the price comes to you. If you understand pharmaceutical distribution because of your professional background, then go deep there. Your professional knowledge is a genuine and legal competitive advantage that no Wall Street analyst who rotates across 20 different industries can match. The critical warning I must give you here is where I must stop and give you the most important warning in this entire video. The enterprising path is genuinely superior in potential return, but it is only superior if you actually do the work. And here is the brutal truth about human nature. Almost everyone who decides they are an enterprising investor is not actually doing the work that justifies the title. They read the financial headlines and call it research. They watch a video about a stock and call it analysis. They hear a compelling story about an exciting company and call it a thesis. They feel confident about a purchase and call that confidence knowledge. This is not enterprising investing. This is speculating with extra vocabulary. The damage this causes is severe because these investors take on the risks of the enterprising path without developing any of the genuine edge that makes those risks rational. They build concentrated positions in individual businesses they have not truly studied. They trade frequently, generating tax costs and transaction costs and emotional costs, and they produce results that are dramatically worse than what the boring defensive investor achieves by doing almost nothing. I want you to sit with this for a moment because it is uncomfortable if you cannot clearly articulate what a company actually does, how it generates its revenue, what its primary competitive threat is, what its profit margins have been for the last 7 years, and why the current price represents value that the market has temporarily mispriced. Then you do not have a thesis, you have a story. And as I said in a previous video, stories are the most expensive thing you can buy on the stock market. How to know honestly which one you are. So how do you determine with real honesty which investor you actually are? I want to give you 4 questions, and I want you to answer them privately, and without any concern for which answer sounds more impressive. Question 1. In the last 12 months, how many full annual reports of individual companies have you read cover to cover? Not summaries, not articles about the company, but the actual report with the financial statements and the footnotes. If the answer is 0, you are a defensive investor, and that is completely fine. If the answer is 3 or more and you found the process genuinely engaging rather than painful, you have the raw material to develop into an enterprising investor. Question 2. When you have made investment decisions in the past, were those decisions based primarily on financial analysis you conducted yourself, or were they based primarily on information you received from someone else? If you are being honest, most people who believe they are enterprising investors are making decisions based on information they received from someone else and translating it only slightly before acting on it. This is not analysis. This is the herd dressed in different clothes. Question 3. Can you describe in precise, specific detail what the difference is between a company's revenue, its gross profit, its operating profit, and its free cash flow? And explain why each of those numbers tells you something different about the health of the business. If that question made you uncomfortable, the defensive path is almost certainly your path right now. That does not mean it is your path forever. Knowledge can be built, but you should not be taking on the risks of the enterprising investor before you have built the knowledge that justifies those risks. Question 4, and this is the most important one: when the market fell sharply in the past, what did you actually do? Not what do you wish you had done, not what do you tell people you did. What did you actually do? Did you hold calmly? Did you buy more? Did you feel genuine analytical confidence in your positions? Or did you feel anxiety and uncertainty and a very strong urge to do something, anything, to make the discomfort stop? If you felt anxiety and uncertainty, you do not yet have the foundation of knowledge and conviction that the enterprising path requires, and attempting to walk it anyway will be expensive. The one thing both investors must never do before I give you your assignment. I need to tell you about the third type of investor, the one that neither path describes, and the one that produces the worst results of all. I call this investor the confused investor. The confused investor is someone who has decided in theory that they want to be enterprising, but in practice is unwilling to do the actual work of enterprise. So they end up with the worst of both worlds. They have the concentrated individual stock positions of the enterprising investor without the deep analysis that justifies concentration. They have the activity level of someone who is trying to beat the market, but none of the systematic process that would give them a genuine basis for doing. So they check their portfolio constantly because they are anxious, not because the checking tells them anything useful. They buy and sell based on a mixture of half-digested information, genuine emotion, and periodic bursts of false conviction, and they underperform the simple index fund investor by a wide margin while working many times harder and suffering many times more stress. The confused investor is not stupid. They are simply in the wrong category. They have not been honest with themselves about which path they are truly on, and they are paying dearly for that dishonesty. The fix is not to work harder in the confused middle. It is to make a real decision, commit to one path fully, and execute it with discipline. Your assignment. Here is what I want you to do. After you finish this video, take a piece of paper and write down your honest answer to these 3 things. First, write down how many hours per week you genuinely have available for investment research. Not the hours you wish you had, the hours you actually have, given your work, your family, your health, and every other real demand on your time. If that number is less than 5 hours per week, you are a defensive investor, and you should invest accordingly. Starting this week, low-cost, broadly diversified index funds, bought consistently, with the discipline to never look at the short-term price movement, and call it information if that number is 5 hours or more. Write down the second thing. Write down the one industry or category of business you understand better than most people because of your professional experience, your personal obsession, or your years of careful study. That industry is your starting point, your circle of competence, your edge, and the only place you should be looking for individual investment opportunities until you have proved to yourself over several years that you can generate results that justify the effort. Then write down the third thing. Write down what your actual behavior was the last time the market dropped significantly, not your intended behavior, your actual behavior. If there is a gap between what you intended to do and what you actually did, that gap is the most important piece of investment information about yourself that you possess. Do not ignore it. Fill it with knowledge and with a written process before you take on any more individual stock risk. Both paths are honorable. Both paths lead to genuine wealth over time. The only dishonorable path is the one in the middle where you pretend to be one thing while actually being another. The bottom line: the defensive investor chooses simplicity, consistency, and the near certainty of good returns in exchange for the possibility of exceptional ones. They do this deliberately, and they do it well, and they will almost certainly end their investing lives richer than the majority of people who tried to be more clever. The enterprising investor chooses depth, focus, and the genuine possibility of exceptional returns in exchange for a substantial and honest commitment of time and intellectual effort. They do this rigorously and within a well-defined circle of competence, and they will earn the right over time to results that justify the work. Both are intelligent choices. The unintelligent choice is to be neither fully one nor fully the other, to drift between them based on mood and market conditions and the stories you are telling yourself in any given moment. Know which investor you are. Commit to that path completely and let the compounding do what compounding has always done for the patient and the disciplined. That is the defensive versus the enterprising investor. That is how the intelligent investor thinks. Thank you.